Hello, Mavericks. How's it going? This is Rob Reinhold. It is nice to be back after being gone for the last 2 weeks, and I'm joined by Darren Fisher. It is good to be here. Let's get into what happened this last week. Now, this last week had a lot of news. So I'm just going to start off with the big elephant in the room. It was the Fed meeting. The Fed meeting on Wednesday, they came out, they raised rates by 25 basis points as expected, and the market cheered it. Cheered it initially. The market ran up about 1% or 2%, and then the press conference started, and then the market tumbled about 3% off that high, and then the next day the market recovered everything it lost. So we had a lot of volatility, but by the end of the week, the market kind of settled in where it started the week, which tells me there was a lot of this already priced in. Now, Darren, I don't know how much you listened to the Fed press conference, but what did you take away from the statement and the press conference and then the market action once they announced it on Wednesday?
I don't like to listen to those because honestly, it sounds like Charlie Brown's teacher half the time. And there's a lot of contradiction right there. Really, I looked at the market action and it was really the last hour and a half of the market where everybody just gave up the ghost. I think you're right. What was expected happened, but then everyone looked at it and said, "Where do we go from here?" I don't think there was anywhere else for them to go from here. They got the move they wanted. There was no impetus to push it further. So in that last hour and a half, it was like, we're getting no follow through on this, guys. Let's start dumping these positions. So this is one of those things where I don't think you need to necessarily look or listen to the Fed statement. You just have to look at the market action and go from there. I remember you telling the story once. You'd been wondering what the Fed decision was going to be. I think you were traveling or something like that. And then you're looking at the market action and realize that you don't need to listen to the press conference. You can just look at the market action and let everyone else have that dogfight right there. One thing that did surprise me is Thursday and Friday's action. I think we're in this period right now where we got the rate hike we expected, and now we don't know exactly what to do because manufacturing PMI, services PMI came in hotter than expected, so inflation's still out there. It looks like they're going to have to raise, and this is in the midst of it's coming out that we had some very poor supervision over a lot of these regional banks. So the Fed is just stepping from landmine to landmine and hoping they don't put too much pressure down and blow something up. That everybody's on tenterhooks right now when it comes to the Fed. That's my takeaway from this week.
And you can see this in the underlying market. We're going to take a look at the charts here in just a second. But the S&P looks very sick right now. The S&P looks bad. There doesn't seem to be a lot of enthusiasm for stocks in the S&P. However, you look at the Qs. The Qs are trading the highest they've been trading for 6 months, maybe even more. So we definitely have all these undercurrents in this market that is making it a little difficult. And so we've been talking about the weakness in the S&P and the strength in technology and communication services. We've been talking about that for the last couple of weeks. On my end of market video I did on Thursday, I said I think it's going to come to a head on Friday. And if you take a look at Friday's price action, we had an ugly open. We had ugly selling. And then we bottomed out. And all day long, people came in and bought and bought and bought and bought. And by the end of the day, it was positive. It was positive. The whole market was positive. And I talked about how one of two things are going to happen because typically the SPX and the Qs are highly correlated. If one goes up, the other goes up. One goes down, the other goes down. Right now, we have the SPY going down. We have the Qs going up. At some point, they will become correlated again. So the question is the SPY going to drag the Qs down, or are the Qs going to pull the S&P up? And I think we got our answer on Friday that the Qs look like they're going to pull this market up. Now, again, we'll take a look at all the charts. We still need more confirmation, but at least that's where it looks like on Friday. We already covered the Fed announcement. And Darren, you mentioned the PMI was a little bit better, and you can see durable goods a little bit worse. very mixed bag. And that is the point, is we are at a point where everything is very mixed. This is where I highly recommend to all of our traders to throw away your opinions. I received a few emails this week from traders saying, Rob, I don't get it. This market should be tanking. Why isn't it tanking? And I give a couple reasons why, but I said, look, it doesn't matter. What matters is the market is not tanking and the Qs are about ready to break out to yearly highs. That doesn't matter why. I used to yell at my screen as a young trader, why, when it was frustrating because what was supposed to be happening wasn't happening. It was very frustrating. I never got an answer back from my monitor, so I stopped asking. And at some point, you have to just stop asking. And one of my favorite stories of all the years of Maverick is when Joe Jensen and I were having a argument about a trade. And I wanted to go one way, Joe wanted to go the other way. And I said, Joe, and I gave him all the reasons. I said, Joe, I know I'm right. And he looked at me and he said, I don't care if I'm right. I just want to make money. And I realized, oh my gosh, I'm more concerned about being intellectually correct than being on the right side of the trade. And that has always stuck with me. So if you are bearish, if you are really bearish, let's look at the charts. Let's look at the charts and let's see, does the chart tell you to be bearish? Let's quickly run down the weekly returns. As you can see, everything up about 1.5%. The Q's outperforming again. The Russell 2000 underperforming. Oil up, gold flat. So basically, we had a generally positive week by the end of the week. Let's really focus here on the SPY. So we had this move. There's no question that that was a market top. We came down, we came up, we moved down. Now look, I'm not a huge Elliott wave guy, but Elliott wave people, they would label this an ABC correction, possibly. But again, I'm not a big Elliott wave guy. But look, we had this pullback. There's no question that the S&P has been weak. And right here, right now, where are we? We are basically on the 20-day moving average. We're below the 50-day moving average, and one of these is going sideways and the other one's about flattening out. This is not very clear at the moment. So when you take a look at the SPY, what you can say is it's been weaker than stronger. And this is potentially another bear rally that we could sell into. Like, that is a purely technical reading of the market right here. This is probably another bear rally that you should sell into. Let's come over here to the Qs. Wildly different story. We've got a market trading solidly above the 20 and 50. Both of them are sloping higher. We are knocking on the door to breaking out of some serious resistance. Here's the question. Which one is telling the truth? Which one do you follow? Now look, what you could do is you could be long the strong, short the weak. That's what we do at Maverick. And so that's what all of our traders should have been doing, where you are long technology, communication services, and basically short everything else. But at some point, these will become correlated again. So the question is, are the Qs going to pull up the rest of the market? Are the Qs going to break out next week and pull up the rest of the market? The close of today, that's what it looked like. Now look, we'll have a whole weekend. We'll get more data, more information. We might fail this next week, and the S&P will drag down the Qs. But on the close Friday, it looks pretty much that the Qs want to run higher because we did close at the highs. We've got the VIX really just doing nothing here. A little bit more elevated than it was a month ago, but really there's nothing here telling us anything. So Darren, let's go back to these charts. What is your analysis here on these charts, and what do you think is likely to happen?
I want to say that I want to prove my point later when we go over sectors. Because right now the score, sector-wise, is 2 to the bullish side and 8 to the negative side, or neutral. 8 to negative and neutral. We'll see that here in a little bit right now. So if I had to lay odds, on whether or not the S&P pulls down the Qs or the Qs pull up the S&P, just statistically where the sectors are leaning. I got to see the S&P pulls down the Qs.
All right. Well, this is what makes a market. This is what is fun about trading. To traders who have been doing this for a very long time, sometimes look at it differently. Now, here is what you need to do. So let's make this like you're either Team Rob or Team Darren based on your analysis and your biases and all the things. You can be that way because right now it is not clear. So if someone came to me, just like Darren says, hey, this is my point, I'd have to say that is very possible. I could be wrong. Yours is very possible. At some point, we will know. Here is the hard thing about trading. Can you admit you're wrong and jump on the bandwagon with the team that was right? That's trading. That is trading. You want to be on the winning side. You have no allegiance to long or short. You have no allegiance to anything. You want to be on the winning team. So again, we're going to take a look at these sector charts. Let's break down this week's events. I think the dollar and the interest rates are the thing that is giving this market a little bit of life. We have interest rates down to 3.3%. Remember, we've been selling off because of rising interest rates. And now the bond is back down to 3.3. We were talking about 4 weeks ago. This takes a lot of pressure off a lot of markets and a lot of stocks. Also, the odds for a rate hike at the next meeting in May are now only 25%. Now, of course, it's a far way away. We could get more data. But the market is saying that interest rates probably aren't going any higher this year. That's what the market is believing, and that is going to support stocks. The dollar index is at 6 months low. A very strong dollar is another thing that hurts U.S. stocks. A weaker dollar index actually helps. So we have these things that are counteracting the bad news that we're seeing. We've talked about tech and comm services. We'll see what happens to them. But this week, we had a very busy schedule last week on economic reports. This week, there's really only one thing to talk about, and that is going to be the core PCE price index on Friday. This is the Fed's preferred inflation meter. Had a very difficult week this week and closed positive, and we ended up on the highs on Friday. We have this very big report coming out on Friday that could sink the ship. I'm looking at this week thinking we might have a positive first part of the week and a negative end part of the week. I think that's how the script is possibly going to go. But that Friday report, if this number comes out hot, all the things I just talked about, the weak dollar and the lower interest rates, those are going to reverse, and that's going to put some pressure on stocks. So we're going to do two markets here. We're going to do the spiders, the S&P 500. The S&P 500 is like a negative 0.5, maybe a negative 1. So it's slightly bearish, but not hugely bearish. And then we come over here to the Qs, and the Qs are bullish. Right now, we have a divergence. The positive correlation has been broken between these two, and they are moving completely separate. The question is, which one? They are going to become correlated again. Which markets are going to be the one that win? And I agree with you, Darren. I think the answer lies in the sectors here. So let's take a look at these sectors.
Yeah, kind of interesting. So we're looking at the performance right there. A little bit of a mixed bag. Comm services, tech, and even materials, had really decent weeks right here. I mean, utilities, real estate, those are interest rate dependent. Those were down both about 2%. But then a lot of, we got three sectors that did nothing. Industrials, financials, consumer, they had a lot of movement, but didn't really make a whole lot of headway right here. So it's a very mixed bag, and we'll see. And for those of you keeping a box score at home, let's go through the individual sectors and see what's positive and what's negative here. So taking a look at utilities, you can see on Friday we were up there, just touched the 20-period moving average. I mean, it was up 3% day for utilities, but it's still below a lot. We've had Tuesday, Wednesday, Thursday, really bad days, and it wasn't able to recover. So Are we on our way back up? Could possibly be, but currently right now, I got to put utilities at a -1. And that's down from a 0 the previous week. Now look at communication services. This is one of the ones that's been looking good. I'm at a +2. It looks like it's going up there. We're, getting a little more space between the 50 period and the 20 period moving average in the price action right there. And this looks pretty good. It's on a nice march up. It's got, some more ground to make up before it hits its January highs. I mean, that's quite the space to go, but it's moving up there step by step. It's trudging up the hill, and I'm happy to be long communication services. Now you look at real estate, and this is one that's accelerating to the downside. I mean, we couldn't take out Wednesday's high on Friday, so we had a really good day, up 2.5%, but still down for the week, and down for the week fairly significantly right there. So we'll see if we can regain some. But this chart is just telling me that even with Friday's up day, you're accelerating to the downside in real estate, getting further away from that 20 period moving average. You take a look at that gap right there. Moving on to industrials, it's telling me the same thing. This is more in a low base, not exactly tracking that 20 period moving average, but it's it's a fairly wide base, and we broke below the low of that base, but we were able to come up, through the day. We were up, about 0.5% for the day. But for everything else moving down, real estate just wants to be weak. You take a look at how everything else did. It's just a weak sector right now that, to me, it looks like it's a low base that wants to keep going down. Looking onto healthcare right there. I mean, this is one that's not looking quite as bad. I got this at a -1. Because we've managed, but it's just we're in this little, what looked to be a bear rally, and now we're turning into a base. Do we get to a 0? Does the 20 period moving average catch up and let us say, okay, we're pegged between the 20 and the 50 period moving average? We can be at a 0 right now while we gain some steam. Time is going to tell on that one, but still, I'm mildly negative on healthcare right there. You're looking at financials. I got to say -3, on this. We were low basing, and even with today's market action, we're still below the low of that low base right here. So this is, to me, -3. This is the worst looking sector out there right now, and that's for a couple of different reasons. But this is one that tells me this is a major mover, especially within the S&P, not so much the NASDAQ, but especially within the S&P. Financials are a very large part of the market cap of the S&P. And there's just not a lot of faith in the financials right now. So, I think financials is going to be seeing a lot more downside. On to consumer. It was at a 0 last time we talked, but I'm at a -1 right now. I mean, we're below both the 20 and the 50. We're so close to that 20. I'm going to discount that one a little bit right now, but it looked like a classic bear rally up to the 50, and then it just turned right over. And it looks like we want to go down. So, give me a couple more candles to the downside, and I got to say -2. But as it is right now, just mildly bearish on consumer. Tech is the only other one that looks good to me. I got a nice +2 on tech. We broke above January's highs. We're in new territory for the year, looking pretty good. But between comm services and tech, in which those are two sectors that have quite a bit of overlap, and they're the two sectors that have the greatest weight on the NASDAQ, these are the only two that are looking good. So I think, where you're looking at the broad market, when you're looking at the Qs, you're kind of seeing a false picture of what's going on when you take a look at everything else that goes into each of these broad market ETFs. Now let's take a look at materials right here. And this is one I wanted to be bullish materials for a good part of the year, but we broke down, we've not recovered. We've had that nice bear rally right there, and it confirmed it was a bear rally. It went down. We've not regained Wednesday's highs, even though we were up a little bit on Friday. I mean, this looks like it could be either be turning into a base or accelerating to the downside. So a lot of different things going on in materials. Finally, taking a look at energy. And this is what we said this before. You've got to be absolutely mercenary when you're a trader. Last year we made a lot of money on energy. This year we can make a lot of money to the downside on energy. This is one that's -2. This mirrors not quite materials, but we had that bear rally, comes back down. We're at the lower end of the range. We break below that 76 level right there, and then we're in -3 territory as far as energy goes. But there's a lot of stuff that's just looking so weak out there. So let's look at how everything stacks up. As I was saying before, if you're going to keep score, there's only two sectors, tech and communication services, that are in positive territory. There's not even anything at neutral right now. So we've got the remaining 8 sectors at a -1 to a -3, with most of the stuff at a -2. This is why I think the S&P pulls down the NASDAQ rather than the NASDAQ pulling up the S&P. The weight is just, if you put a balance on this market cap wise, then I think the selling pressure is to the downside, and NASDAQ is going to have to make this Herculean effort to try to pull up the S&P. I could be wrong, but this is what the analysis is telling me.
So I wanted to go back and see, when was the last time we saw this sector outlook board? I mean, this almost never happens. This almost never happens where you have such a divergence between markets. As I said earlier, this is definitely a very, I don't want to say confusing, but lots of mixed signals going around. This is where, look, when there's mixed signals, you don't have to be aggressive. You can sit back and wait. You can just sit back and see what happens. And then when it gets more clear, then you put the pedal to the metal and you start to get going. But this is definitely a very complex sector outlook to figure out where the overall market is going to go. So I think, what you said, Darren, I think your analysis is spot on. I'm leaning the other way, but that's fine, because I will ditch my premise on Monday if I'm wrong. And I'll happily join Team Darren and be on the short side and ride this down. I think that's where you have to be as a trader right now. You can have your...
Oh, absolutely. I've got to be the same way. I mean, the price action doesn't lie. If the S&P kicks it into another gear, I just got to tear up all my previous analysis. I've got to tear up all my previous biases. I think one thing that you could do here, and we haven't done this for, a year and a half, is ignore, or maybe even 2 years, ignore the broad markets, ignore the spiders, ignore the Qs, and just trade each sector individually, picking and choosing the strongest in each sector or the weakest in each sector, and go from there. I mean, that I think would remove a lot of confusion. Taking a look at that would obviously put you on a negative outlook, but you'd be bearish on the stuff that it's profitable to be bearish on. You'd be bullish on the stuff that's profitable to be bullish. Maybe take a look at some pairs trades as well. I mean, this is one of those things where you have to start pulling out some interesting tools out of the toolbox and take a look at what's going on and how to make money. So let's take a look at some potential trades. Last week we were long AWK, and that was only, it went nowhere. Okay, it was up 0.02% right here. Just a lot of little noise. That's fine. We've got a couple more. I think we've got another 2 weeks left on this trade. So just see where it goes in the next 2 weeks. Not looking bad. So this week we're looking at Southern Company right here. We're going to play this one sideways to bullish. How do we want to do that? You can see we've got a pretty classic bull pullback right here. We pulled back right to the 50, and we had a nice little confirmation candle right there. So I think the best way to play this is going to be with a butterfly with a 69 target. Your wings, you can pick which ones to do. I think you'd probably do 66, 69, 72 would be, well within the realm of possibility. Give yourself a good 2 weeks to do this, and I think you're up there. I think the profit area on this one's going to be pretty good. If you overshoot a little bit, that's not going to be a problem. Communication services. Last week we were long Spotify, and this again, despite the fact that communication services went up, this went up a little bit, but it was only up 0.95%. It's still kind of in a base. It's fine. We'll see if it catches a bid. We've got another week left on this, or 2 weeks left on this, but still trade's looking pretty good. We're in that nice high base. This week we're looking at Baidu. This is a nice little bull flag right here. Going up there, it went and cut through the downtrend line fairly good. We've been 5 days on it. So how do we want to do this? Go out to April, go long that 150 call, and then short next Friday's 160 against it. Okay, you're not asking it to do a whole lot. You're asking it to move up $2.50, which, considering how volatile this is, it's probably a pretty good chance that's going to happen. and then just hang out there. You're just giving it 1 week, and then see if you want to go. You got those 150s that you can still be long. You can re-diagonalize it. You can verticalize it. You can do so many things with this. So what I like, these very short mini diagonals. You're not locked into the position. You get rid of the whole thing on Friday if you don't like the way it's acting. So Baidu's looking pretty good to the upside right here. And healthcare. Last week we were short NVCR, and you can see it really didn't do a whole lot. Okay, it just kind of based there. It was officially up 0.18%. This is still in that low base right there. I mean, so we've got some more time on this trade. This looks like it wants to break down, just as low as it, as things get here. So I think you've got a good time. This is one of the things, you've got time on your side. Another couple of weeks, let it play out right there. This is, if I remember correctly, this is a pretty chicken bear play that we had. So we're just looking for a little bit of movement, not a whole lot. This week we're looking for AbbVie. This had a nice little breakout right here. You can see we've got a pretty solid target to do. Go out to those April 150, 250s, and then just short the 160s against it. And this is looking pretty good. You've got some serious resistance back there. You're giving this a week trade, a 1 week trade to do. Yeah, I like this one. I like where this one could go. Just drift up there to 160 in the next 5 days of trading. I think you're going to be paid handsomely for that. If you start beating your head against that 160, doesn't look like it wants to go ahead, get out of the trade. If it looks like it's got some momentum going for it, then again, you can re-diagonalize it. You can turn it into a vertical. There's so many things you can do with this since you've got the that long call below it.
Industrials, the first 6 weeks of the year, was the best sector. It looked great, and then it died. It literally just turned over and said, I'm now the worst sector almost. So last week we had a short on AZEK. You can see this one had a pop early in the week, and then it fell, and then actually closed down here at some really nice levels here. Here's what I love about these picks. Take a look at Friday was an up day. Friday was an up day. Thursday was an up day. We had down candles on both days. That's what you want to see. If you're short a stock or you're in a bearish options play and the market goes up, you want to see your stock either go nowhere or down. That's telling you you're in the right spot. There's no reason to think this thing isn't going to break and drop down to this 20 area. So this trade looks fantastic here. This week, since we already got a bear, we're taking a look for something that is a little bit more bullish here. It was pretty tough to find a bullish trade in industrials. There's not a lot out there, but I want to really make sure that you understand if you're going to go bullish in industrials, it needs to be a chicken trade. It needs to be a very, very small trade. This is one of the only ones in the sector that is looking really good. That being said, we don't have a confirmation yet. We got a new swing high off of better than expected earnings, and we've just simply pulled back from there. We are still pulling back. On Friday, remember, Friday was an up day. We had a down candle. So this one is not ready to go yet at all. This one's going to take at least a few days to develop. But if we do get a bottoming out at that support line and we get that green candle higher, then I think it's time to look for it. But do not be as bullish as looking at 230 or 240. That's not where this market is. I think 225 is about as much as you can ask for this thing to go. And on a stock like this, that's really a reasonable target here. If you want, even bring that down to 220. Do the 215, 220. Now you're asking for it to do even less. Right here, right now, unless it's tech or communication services, you can't ask your bullish stuff in other sectors to do all that much because the wind is against them. Speaking of the wind is against you, let's jump into financials. All right, last week we had a short on KeyBank. KeyBank, as you can see, basically went nowhere. So this trade is looking really good. We just don't want this thing to break up and come up here into the 14s and 15s. Got more time on it. Trade looks just fine. I went through a bunch of trades in the financial sector, and they all look like this. They all look like this. So we're at these extreme points. understand this is a very boring, stable stock that went from 18 to 11. That is a monster move. So really, two things are going to happen here. Either there is more banking crises on the horizon, and this thing could easily go down to 9 or 8 or 7 or 6, who knows? Or there isn't, and this thing is going to creep up, back up to a reasonable valuation level. Do you see how that's a very difficult trade? Either the slowest trade on the upside that you could possibly think of, with the potential of any time there being a banking crisis and this thing gapping down 30%, or you could be short the whole time, fighting the tape, fighting if there's no banking crisis, this thing is going to keep creeping up. And you're hoping and praying there's some bad news to actually give you that drop. I don't like this setup at all. And so I'm just going to throw up, I'm not trading financials. I'm not trading financials until I get a little bit more clarity. Look, you can trade financials if you want. That's fine. Just do it in a very, very controlled manner. No, I would say don't touch any stock. Don't be in any equities. Be in very, very tight vertical spreads. That way you can play these kind of plays and you won't get crushed. Darren, anything you want to add on that?
I'd actually look at some of the industry group ETFs. If you don't want to play XLF itself, look at some of the industry groups. There's a couple in there that don't look too bad to the upside. A lot of stuff looks bad to the downside, but being in those ETFs, it's going to mute the volatility of a single stock exposure. So I think I would be playing spreads on the ETFs rather than spreads on the individual stocks.
Very good
That's
advice.
the only other thing I'd say. All right, consumer. Last week we were sideways on lows, and we're at the kind of the bottom. You know, it kind of dumped there on Wednesday, Thursday, and tried to make a little bit of a comeback on Friday. So we've got a little bit of time left on this one. This one needs to come up to about the, I want to say about the 195 level, and then we're going to be back in the black on that one. As it is, I mean, you just got to wait and see. That's why we size these things for max loss. This week we're looking at TJ Maxx, nice bear rally. I mean, this thing confirmed on Thursday. You can see it just roll right over. I mean, we had a bearish engulfing on Wednesday and a follow through on Thursday. I mean, this is great. Go out to April 6th and take a look. Give yourself about 2 weeks to do there. I think a target of 73 would be good. Do that 73, 76 bear call spread. You're going to probably have it a 1-to-1 reward risk ratio on there. Get yourself a little bit of theta. I think that's the way you play something like this. This looks weak. It looks like it wants to go back down to the bottom of that range. Quite happy to have that one in the portfolio. Technology. Last week we were long First Solar, and First Solar performed well for us. It was up 5.75%. I think we were short that 210 in a spread right there. So we probably either you got rid of the whole position, you bought it back for $1.15, and kept the longs. I think you probably would have been long the 200s. This is looking great. This is one of those ones. Take a look at what you want to do. Did you roll today? Are you going to roll on Monday? Do you want to? You could go up to the 215 level. I think would be a good place to roll this to for another week. Right there, and then reevaluate. This week we're looking at Fastly. This has been a nice high base. It's kind of stalled right here, and he just needs a little bit of kick. So we've got in longer term, we've got a nice high base. Shorter term, we've got an ascending triangle. Things are starting to get really compressed right here, and you can see when they start to get compressed, right there at that $16 level, there's a lot of things that people just want to break through it. As soon as you can break through that overhead resistance, I think you could have a target of 18 would be good if you gave yourself enough time. So what's the best way to play it? I am just looking at the chart here. But I think some sort of a diagonal spread would be the best thing to do. If you want to wait for that breakout above 16, go right ahead. I think what I would do initially this week, if you don't want to wait for the breakout, just go long those 15s, short those 17s, and give it a week and then see if it breaks out. Then re-diagonalize it up to, keep those 15s on the long side, re-diagonalize it up to 18. There's a nice 2-week trade for you right there.
I was with you, Darren. I really thought the materials sector was going to be one of the standouts in the first quarter of this year. Like industrials, it started out great, started out strong, and then, boy, just rolled over. So we had a short in Lithium America Corp LAC, and this is again what you want to see. This stock didn't go anywhere on a week that the market actually went higher. Now, look, it didn't drop yet. We are in a slightly bearish play, so this is just fine. Everything looks just fine on this trade, so I think we're going to just let it work itself out, and look, it either works or it doesn't. This week, we are looking at Linde Chemicals. Right, so looking again at another bull here, just like in industrials, we've got some short stuff working, so let's take a look at some stuff on the other side. Not a lot of bullish stuff here, but you can see we did make a clear break to new highs. And when we had a big, deep pullback, we found some support, and the candles have been really good over this past 2 weeks. And today's candle was actually one of the best. We closed up near our highs. Now look, we are in a market that is not super bullish. If we were in a +2, +3 market, we would have a target somewhere around 360 on this, or maybe even 370. I'm looking to be a chicken. So I think you look at 350 or 355 as the best case scenario of this stock. So you could do a 345, 350 bull call spread. You could do 345, 355 bull call spread. I did the 345, 355 because I want to get a little bit more bullishness on this. But look, nothing other than tech and communication services are telling you to be wildly aggressive on trades. Everything is telling you to do, like Darren has been saying, diagonal call spreads. This one's a little pricey for a diagonal call spread. This is why I'm looking to do a vertical spread. But again, don't ask for much on these trades. And let's finish this off with energy. Last week we had Apache Energy. It did have a pop on Tuesday, but you can see it slid right back down. We have more time on this. There's no reason this thing doesn't go back to 32. The whole energy sector does not look very healthy right now. Let's jump on to the trade this week. We're looking at sideways here on Valero Energy. So whenever you are looking at a sideways, the question is, are you truly sideways? Are you a little bit bullish, like a +1, or are you a little bit bearish, a -1? I'm looking at this one and saying, I think we are right in the middle here. We've got some real serious resistance at 135 short term. It's a pretty good short or support down here at 125. That's my range. So I'm looking at 125 to 135, and I'm only going out a week. So this is going to be a 1 week trade. And basically, if it stays in this little area, I'm highly likely to make some money. If not, I've got a limited risk amount out there. I position size for max loss. If it blows out from the top of the bottom, hey, it's a losing trade. I move on to the next one. That's the trades we have for you. If you have any other trades you want to share with the rest of the Maverick traders, log on to the website, jump into the forum, and let's get that discussion going. Let's wrap this up. I'm going to put no clear consensus on market direction. I have a theory. Darren has a theory. Well, let's call those more of hunches or guesses. At some point, it will become clear. And that's when we're going to really be able to open it up and say, hey, this is very clearly happening. Let's get more bullish. Let's get more bearish. Right now, if you don't feel it, if you aren't feeling like you want to deploy a lot of capital, don't. At some point, the spiders and the hues will become correlated again. They'll move together. That's when you can deploy more capital. So just realize we are not in one of those parts of time in the market where it's clear where everything is going. I mean, like in 2021, it was so clear it was a bull market. And in 2022, it was pretty clear it was a bear market. This point right here, not super clear at all. Anything you want to add to that, Darren, before we let people go?
No, this market is lacking in clarity. Like I said, you can see up there, I think that if you want to clear your mind, trade sector by sector and look at each individually. And I would even, in something like this, I would even consider cutting my position sizes in half until the markets become recorrelated one way or the other.
All right. Well, there you have it. Everyone have a great weekend, and let's go make some money next week. Goodbye, everyone.
Good trade, everyone.